The October 2024 budget brought in a few changes, but for many of you, the biggest change was bringing pensions into the inheritance tax regime. And so the question now has to be, what now? Hi and welcome back to the channel. My name is Pete Matthew and I'm a 27-year veteran chartered financial planner based here in the UK. And this video is brought to you by Meaningful Academy Retirement Planning. More on that a little bit later. The changes to pensions don't come into force until April 2027, so we've got time to plan, okay? But in this video, I want to outline the changes and think about some possible planning angles that I reckon are going to be keeping me and my clients busy in the coming months and years. So in simple terms, from April 2027, any unspent pension fund will be part of your estate when it comes to calculating inheritance tax. So if you've got money in a drawdown fund, or a pension fund which is uncrystallized, then the value of that money will be added to everything else you own, totaled up, and if it's over a certain figure, will be subject to inheritance tax at 40%. Now this is a big change because since 2015 and the pensions freedoms, pensions have been a really effective and useful vehicle for passing money to your family when you die. They've almost become more useful as an estate planning vehicle than as a retirement income vehicle, which really is the whole point of a pension. So it kind of figured that something had to give here in the budget. It looks like the pension scheme will have to calculate the amount of inheritance tax due and pay HMRC directly from your pension fund within 6 months of your death. Now this means that your executors will have to coordinate with the pension schemes pretty closely and quickly in order to make sure that the calculation is done in good time and avoid interest payments. Now other than inheritance tax now being chargeable, what happens to your pension on death actually hasn't really changed. So if you die pre-age 75, then your pot passes to your beneficiaries after inheritance tax at 40%. But they can draw from the balance of the fund, tax-free for life. If you die after age 75, then you'll pay any inheritance tax first, and then the pot will pass to your beneficiaries. And again, there's no tax on transfer to them if they retain it as a pension fund. But when they draw it out, there is income tax to pay or whatever their notional rate is. So whatever they take out of the pension pot will be added to their own other income in that year, and the total will determine what tax rate they pay. Assuming it's a decent sized pension pot and your beneficiaries draw it all out in one go, worst case, you're looking at 40% inheritance tax and then a further 45% income tax charge on what's left, 48% if you're in Scotland. Add all that tax together and you get a notional rate of about 67%. Your beneficiaries will lose 2/3 of your pension fund before they get to keep 1/3 of it. But potentially, it's even worse than that. So you may know that everybody gets a £325,000 nil rate band for inheritance tax. In addition, if you own your own home and leave it to your direct descendants, there's another residence nil rate band of £175,000. Add these together and you get an inheritance tax-free allowance of £500,000. But if the value of your estate is over £2 million, your residence nil rate band is tapered. It's reduced by £1 for every £2 of your estate over £2 million. So if your total estate is 2.35 million, then your residence nil rate band is gone. And more people are going to be affected by that when they add their pension fund in. So potentially, if adding your pension pot into your estate takes you over that £2 million threshold, you've got a triple whammy. You pay inheritance tax on your pension, you pay inheritance tax on more of your non-pension money because of the reduction in the residence nil rate band, and your beneficiaries pay income tax at up to 45% on what's left, 48% in Scotland. So I kid you not, I've seen calculations where the notional tax rate on a pension fund is 89% or 91% in Scotland. So one thing is for certain, on the back of these changes, which remember, don't come in until April 2027, but on the back of these changes, estate planning and lifetime income planning is going to become much more nuanced and more complicated. For the last 9 years, it's been easy really. You just didn't spend your pension fund and you spent down your other assets, reducing your estate in the process. So one option, I think, is to draw down from a pension pot a regular income, perhaps up to the higher rate income tax threshold, so that you're only paying 20% on whatever you draw. If you then give that money away to your family, it would be outside your estate immediately using something called the gifts from regular income exemption. Now, you can give unlimited sums away and have that money immediately outside your estate as long as 3 conditions are met. Firstly, the gifts have to be made from income. They can't be capital withdrawals, a subtle but important difference. Second, they have to be regular or can be shown to have been intended as regular. And thirdly, they can't reduce your standard of living. So perhaps drawing an extra 10,000 quid a year from your pension fund, paying £2,000 in income tax, but then giving away the net £8,000, maybe that'd be a good idea. You could also use some or all of your pension fund to buy an annuity. That's a guaranteed income for life, and do the same thing, give it away. So let's say it costs you £100,000 of your pension fund to get a £5,000 a year annuity income. Net of basic rate income tax, that's £4,000 a year. Give that away to your kids and we're all good. You've had an immediate reduction in your pension fund by buying the annuity. That saves you inheritance tax. But you'll have to live 25 years to get back in net income the £100,000 you've spent on the annuity. That's quite a big gamble. I can see plenty more people drawing their tax-free cash as a lump sum and giving that away to their kids earlier. Obviously, you have to live 7 years from the date of the gift for it to be free of inheritance tax. But if you do that earlier in life, the odds are pretty good of you living 7 years. I think it's definitely worth saying that given the intention of a pension fund is to provide a retirement income, that you could reduce the impact of the budget pension changes by drawing more and simply spending it on living well. So I can see loads of people deciding to draw more from their drawdown plan and upgrade to business class when they go on holiday, or eat out more, upgrade the car more often, or pay for private medical insurance. In short, they will use their pension for themselves more, which is, let's face it, the whole point. I have a few more suggestions that I think will be part of people's planning going forward, but before I get to them, let me just mention Meaningful Academy Retirement Planning to you. This is my best teaching on how to plan and execute the perfect retirement. As well as all the video lessons, calculators, worksheets, there are 2 key aspects to the Academy. And the first is that you get a year's access to Voyant Go, which is the incredible financial planning software that I use every day to model my clients' financial future. The software allows you to build and compare different scenarios and see the impact of, say, retiring early or giving money away to your family. And the second benefit is the community. There are hundreds of people in the same situation, all helping each other out by answering questions and just generally being great and supportive. So check out meaningfulacademy.com/retirement planning. And if you think it's for you, use the coupon code YouTube for a discount. Okay, let's think about some other planning options now. One option that I think might become more attractive in future, even though it's always been possible, is to draw money from a pension drawdown or buy an annuity and use that income to pay for a whole of life insurance policy designed to pay the inheritance tax when you die. Of course, the younger you are when you take this policy out, the cheaper the premium's going to be. If your inheritance tax bill is a big one, then the underwriting on such a plan is going to be pretty extensive. So think medical assessments, doctor's reports, blood tests maybe. But if you think about it, you're reducing your inheritance tax bill by drawing off your pension, but you're also providing for that bill to be paid using the life insurance. One thing we must be sure to do, though, is to write that life insurance policy in trust. Otherwise, you're potentially just making your inheritance tax position even worse. Something else I think will happen more than it does now is that people might take out equity release mortgages on their home, receive the cash, and give it to their kids. Hopefully, they live 7 years from the date of the gift, so it's outside of their estate. Plus, you have a growing debt on your estate, which will further reduce the inheritance tax bill when the time comes. And finally, though this isn't really a planning angle, it's more an admin point really, I think it's going to be more important to have your pension provision nice and tidy when you die. You really don't want 3 or 4 different unspent pension funds for your executors to work everything out, liaise with the providers to make sure the right amount of tax is paid from each pot. Having just one pension provider and plan will save costs and time when it's all going to be sorted out. Something to think about. Now, obviously, I'm going to be covering this whole subject a lot more in the months to come. So if you're not already, do subscribe to the channel and maybe give this video a like for the almighty algorithm. The key message, I think, though, is that you shouldn't rush to make changes. As I record this, we are 28 months away, more than 2 years, from these changes coming in. They may even alter a little bit before that date, we'll see. Knee-jerk reactions to budget changes, or even worse, rumors about changes, they can do untold damage to your wealth. We should always approach decisions like this in a measured, thought-through way. So please guard yourself against hysterical media and the messaging from so-called experts. They don't have your interests in mind. And remember, first and foremost, pensions are for retirement income. We need to reset our thinking about how we can use our pension funds to live better, rather than simply as a means to transfer wealth to our family. Okay, I hope that was helpful, folks. Leave any questions or comments below and I'll do my best to answer them. Stay tuned for more financial planning methods and ideas, and I'll see you in the next video.